Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're going to break down which small cap ETF is better for your retirement. The NEOS IWMI based off of the Russell 2000 or overlays OVS. Which one's going to fit? We're going to break it down with income, growth, total return, and of course, we're going to break into the taxes because it doesn't matter how much you make, it's how much you keep. So sit back, relax, and let's dive into which small cap ETF fits the best. Get your cup, get your mug, put your favorite beverage in, and let's get into it. Hey, before I make an announcement, why do I make announcements about mugs? Well, this is what supports the channel. We don't take advertisers, we don't take promotions. What we do is to help us with the channel is we produce these awesome looking retirement made easy, living on dividends mugs. We have our standard one 11 ounce, we have our Big Mac 15 ounce, priced accordingly. Don't be afraid to use that QR code or go down below in the link, click on that, take you right to the order page. All of this helps support the channel. That's all we're looking for, a little bit of support. Okay, so let's get into this. The small cap stocks offer some critical diversification beyond today's mega cap technology dominance. Actually, the small caps have actually outperformed a lot of the stuff in the mega caps, and quietly. No one's really been paying attention to it. For retirees, this decision isn't about picking winners. It's about balancing your growth potential with your basically getting your income consistency while you're in your retirement years. So we're going to evaluate IWMI and OVS across those 5 key pillars I talked about. We're going to look at the income, we're going to look at growth, we're going to look at NAV stability, tax efficiency, and the biggest number of them all is total return. Now, before we do this, I got to do this disclaimer. This is an educational disclaimer. This presentation is for educational and entertainment purposes only. Doug is not a financial advisor. The content is all not about buying, selling, giving you advice. It's about giving you the information. Remember, past performance does not guarantee future results. If you need help with any of that, talk to a financial advisor or a tax professional. Hey, before we go any farther, I got to throw out one more new thing that we have. We just put this out there on order. The cups are coming in. Don't be afraid, jump on quick. We got to find out if this is going to be a hot seller or not. But our 40-ounce travel mug. This one actually came because I went out to my car and I'm like carrying my ceramic mug, and yep, I did it. I dropped it, shattered it, had to get another one out. This way, we're going with a travel mug now, 40-ouncer, $27.99. Again, QR code, hit that link down below. This one is a double-walled insulation, awesome for traveling. Let's get in with the video. So IWMI, it's the Russell 2000 with a managed call options. This one comes out of the NEOS family. Okay, the underlying asset is the Russell 2000 index tracking. So it provides exposure to approximately 2,000 smaller publicly traded companies inside the U.S. The small cap diversification acts as a diffuser for retirement portfolios that are often heavy concentrated in mega cap technology stocks. So the growth potential, it captures the appreciation of the broader small cap market before the options overlay is applied. And that's a critical point to this. And I'll do it again. Before they go out and capture the appreciation of a fund, okay? So they're putting funds out there, and then they're going to do the overlay, which is where they're going to collect their income. So you're going to see where this fund can actually grow on its own and still generate income. Now, the other big thing of this is that the small cap versus the mega cap. You need diversification in your portfolios. And this is one thing I think a lot of people miss, that this gives you a big choice, over 2,000 companies, as a more diversified fund. Now, the NEO strategy that they do is they manage their call spread structure. NEOS actively manages and sells and purchases, okay, the Russell 2000 index options to generate that monthly distribution. So as the market's changing, they're selling their covered calls, they're buying other calls or indexes. They may even buy some puts, okay, depending on what the market technically is doing. This creates that premium income generation. The income is primarily derived from those premiums collected by selling index level call options. It's preserving the upside protection, which is what I love about this. They're buying call options as part of the spread, and the fund seeks to participate in that small cap stock rise. So the unique piece to that is that they're able to hold off and get growth while generating income. Now OVS, this is the S&P Small Cap 600, okay? So this is what they use as a put spread overlay. So it's kind of like, and your NEOS is looking for positive. These guys are looking for that volatility, the drop downs and the come up, the drop downs and the come up. So they're really trying to get more of that drop down side of it. It attains 99.8% allocation to the primary exposure of iShares Core S&P Small Cap ETF. That represents about 600 different companies. So right off the bat, you're dealing with 2,000 versus 600. Now, this is a broad diversification across the S&P Small Cap 600 index. Okay? The income and growth strategy, the risk control overlay, generates premiums by selling part spreads using that S&P 500 index. It uncaps small cap upside, doesn't place a covered call ceiling directly on the small caps. So now the big risk here is the overlay can actually lose money during sharp S&P 500 declines, and premiums may not be offsetting the losses. So to understand this even better, they are basically buying and holding the IJR, which is that, again, the iShares Core S&P 500 small cap, and they're also doing S&P 500 put spreads. So you can see where they're getting their generation of growth from the iShares, and they're also getting the income from the S&P 500 put spreads. Oh, it's a unique way that they're and this is why they have their name, overlaying. They're overlaying the different options on top of each other. So the strategy after these two, I'll put it this way. You've got basically a very simple way to understand this. Underlying exposure is the Russell 2000 on IWMI from NEOS. It does the basic index option calling, and it's a cleaner connection between holdings and strategies, both tied to the same index. Now, OVS uses that S&P 500 small cap IJR ETF. They do the overlay with the S&P 500 index, but they're doing puts versus calls. And that derivative overlay, that small cap stocks, and that large cap premium generation. So income-focused retirees are probably going to lean more towards the Russell because of the advantage that you have. It's a tighter alignment that ensures those distributions are anchored in the small cap side of it. If you're looking for more of the growth side, the advantage is going to go to OVS. That structural design avoids a direct ceiling. So nothing's capped. It lets it roll. Let's get into income. Income is a major factor of all this, and that's probably why you're looking at these funds. And I'm going to show you right off, yep, it's going to be the big 14.42% yield coming out of IWMI's distribution rate. So NEOS has a great job with this fund. They've done an awesome job to it. 14.42%, paying out about $1,200 per month off of a standard $100,000 investment. Now OVS is at 9.86. So you're going to be down about $822 a month versus the 1,200 that you're collecting from NEOS. And that gives you an annual number, $14,420 versus $9,860. So the income verdict, IWM definitely wins. Now you remember, on this channel, I tell you this over and over and over. We don't just chase yield. Even though these numbers all look great, we want to see what's happening underneath the hood. We want to see if these things are growing because we need growth in retirement as well. We don't want to be in a yield trap. So right now, that 4.5 percentage points difference between these two is huge. When we take a look even farther into it, the 30-day SEC yield, we see the overlay has a little higher to it. For retirees, these funds are not dividend growth vehicles. They are income conversion engines that turn small cap volatility and the S&P 500 option demand into monthly paychecks. Okay, so the SEC yield reflects the interest and the dividends earned by the underlying stocks after expenses. The massive gap between the yields and the headline distributions confirms that the cash flow is synthetic. Okay, and what does that mean? That means it's coming from their income portions of their options that they're selling. Now we take a look at growth. Now, growth becomes the big question. And I'm going to first put these things up to, let's take a serious look at up against IWMI, up against the Russell 2000. How are they performing in the underlying point and I call the benchmark? So when you take a look at it, the Russell 2000 over the last 1 year trailing is up about 40.78%. Told you these small caps have been doing great. Now, NEOS has captured 36.26%, so only 4% off, but 4.5% off of what their past 12-month trailing has been. You take a look at the year to date, again, you're about the same thing. You're about a 4, just a hair over 4.5, 4.3 to be exact, difference between the two funds. Now, OVS to the S&P small cap, this is where it really gets interesting. OVS has actually been able to outproduce the S&P small cap 600s by about 2 percentage points year to date and about 4 percentage points for past 12 trailing months. So you can see it's outperforming it's technically its underlying asset while the Russell is behind. When we take a look at the growth participation across the board though, IWMI versus OVS, you will see IWMI is sitting at 15.13, while OVS is at 28.23. There's a 13% difference between the two funds. This is huge, and you can see why I made the announcement ahead of time that if you want growth, OVS is probably the way that you want to be. So I'm going to put it as growth with income versus income with growth. Now you look at the bar chart over here. You can see back in December of 25, they were both about almost dead equal at 0 percentage points. Coming out of December of 25, OVS has just rocketed. Even when we've had downturns in the April drop-offs, we've seen the W roll here late June. You just see the thing continues to grow. So they've done a very, very good job of managing and handling that growth side of it in that S&P 500 and in that iShares ETF. Total return though. Total return is what we need to look at. Why is that? Total return tells you if you're going to reinvest your dividends, this is what just gives you the whole total mark to it. 41.46% OVS is leading in that total return market. IWMI, very respectable, 36.26%. Okay, big difference between the two different funds. And we look at year to date, we look at the trailing, they're both basically running identical to each other. So When you take these numbers, how do you break it down? Real simple. Again, it's income that you're getting, IWMI making the income versus OVS's generating income with growth. It really questions where you want to be. Right now, it looks like to me, OVS is definitely the stronger one if you're willing to take that shorter 5% cut of income. Now, none of that means anything. None of the income means anything unless you can keep it. And the tax treatment side of it. This is what throws the next monkey wrench into the whole mix. NEOS. We know NEOS is built on tax programming. They've done probably the best job I've ever seen of managing this with taxes. Now, if you're using this in a brokerage fund, which most retirees will end up into a brokerage fund, this program is tremendous. They do the Section 1256 contracts, which is, basically a 60-40 long-term, short-term capital gains initially. They use active harvesting. And if you don't know what harvesting is where they may have a fund that's down a little bit. They may have one particular stock or something that's down. They'll sell it off. But that doesn't mean they never buy it back. They sold it for the harvesting of the tax purposes and buy back into it. Plus, they also use ROC. And a lot of people don't know that. But the NEOS package, the icing, I call it the icing on the top, is that ROC on top of it all. Now, OVS uses pretty much ROC across the board. And remember when I say this one here is estimated 100%, I want to make sure you understand these numbers are not locked in the stone until you get your 1099 dividend form at the end of the year. They can make adjustments all the way until the very last day of the trading year. Now, based on the management, the ROC reduces the cost rather than taxing immediately. So you are kicking your can down the road. And it's all about that year-end reporting, as I told you about. So the advantage in taxes has to go to IWMI with the NEOS package. Okay, they both use ROC, but there's all the extra pieces that they use to generate and make you hold on to your cash even better after you get done with all the tax side of it. Now we take a look at assets and really the trading liquidity and the size of these funds. So we start off with efficiency. NEOS is 0.68%. OVS is at 0.83. Now, does that really make a big difference? It does if you're holding for long periods of time. Okay, so the lower fee of IWMS. So what I come back with, NEOS is actually giving you a longer hold that's better in retirement packages on that. The only thing I can tell you on top of that is OVS now has to make more income or more growth to cover that gap. Do they do that? So far, yes, they have. Asset scaling. NEOS, $1.07 billion in net assets. OVS, $33 million. Now, in my book, would I like to see OVS get to that $50 million point? And if they did, would I be comfortable? Most definitely. At $33 million, still a very, very strong number. But I have to lean more towards the heavyweight of that $1.07 billion because it gives us the ability, which is the liquidity, which is what you can see here. That the liquidity side of it, IWMI has the ability and has the mark of a lower liquidity position. So overall, more efficiency, more growth, more packaging. It's just NEOS just knocks it out of the park across the board. So let's give you the final scorecard of this. Income generation. The winner is going to be NEOS, 14.42% to the 9.86%. That's quite a big difference. You're really talking about a 4% difference between the two. You do have the capped upside, which is a downfall to the NEOS package, while you have the uncapped upside of OVS. Total returns, 36.26% to 41.46%. So you can see with them not up with the uncapped upside, they've actually took the lead that their growth is bigger. So this is right down the path I've explained to you. Income versus growth. This is what's done in the total returns. It's given them a better answer there. Tax strategy, you got to give the leaning to NEOS with those 1256 contracts versus just doing RLC. You still get RLC on theirs. You have to look at the fees and the liquidity side of it, all lean towards the NEOS of the $1 billion fund and a lower operating fee. And here's the real kicker to all of this. NEOS came out in 2024. So we're just really over 2 years old already. And OVS has been out there since 2019. And when you take a look at $1 billion versus $33 million, it's tough because a lot of people jumped into that NEOS Russell side of things. But OVS, I'm not saying either one of these two funds are bad. Let me clarify that right off the bat. Neither one's bad, but it's where it fits in your retirement portfolio. If you're needing income and you want diversification in your income fund, IWMI is where it really sits. And then OVS really sits if you're looking for additional growth in your portfolio and still generating some income. So to me, the final verdict is this. For retirement income, again, is IWMI. It's best for retirees prioritizing the largest possible monthly paycheck. Okay? You're getting growth. So you're getting more growth than, inflation. Inflation running about 3.5%. You're kicking that butt. You're kicking it down all set. You've structured your taxes properly. You've built in the small caps. You have $1 billion net asset of a fund that you're investing into. And you have a low expense ratio. So that's why I say, realistically, I put this in the income bucket, winner. No questions asked. Now, OVS, even with you always tell me the total return, they win that total return thing. This is best for retirees who are prioritizing growth and capital appreciation. The growth side of it, hands down, they are superior with the growth. They are beating it by over 5%. The benchmark, they're beating the benchmark. That is the kicker to it. They're beating the benchmark. It's the uncapped upside that they're doing with the non-traditional cover call ceiling program. So here's what I will also buy down. I told you about the $50 million portfolio, right? That you should be over $50 million. Here's the thing. They have proven tenure. Longer operating history dating back to September of 2019. So even with that one mark that I normally always say you got to be over 50 to relax, I think this one time has shown that it's locking in. So this is why I say it's my winner in my growth positioning. So if you're putting these in your buckets, one's in income bucket, one's growth bucket, both are great fun to work accordingly. Let me know in the comments below how you feel, which one, maybe you own both, maybe you only own one. I'd love to hear how you guys use it and where you put it and how does it work in your portfolio. So conclusion, guys, successful retirement investing is not about finding the highest yield. It's about building a dependable paycheck while protecting your money responsibility for producing. IWMI is your income bucket. OVS is your growth bucket. Everything that OVS grows, even with that 9%, and you could do this so uniquely, is that 9%, you could roll that back in and all of a sudden you're talking about a 50% growth pattern. That is crazy numbers. If you take that, balance it out every year, IWMI will benefit from what the OVS's growth has been, and then you will benefit from the growth and income of both funds. Let me know which one you choose. Do you like what we're doing? Hit that like button. And most of all, don't forget about our new products, our travel mug. Just another pitch for it. Thanks, guys. Thanks for watching.